It's been sending a signal that we're late cycle at the very least. But I would also emphasize that a lot of the move down we've had in yields lately, even if you have a relatively sanguine view on how the situation is here in the U.S. and the latest data have been okay, is that we're not an island, and global developments have been weaker, and the decline in global rates is dragging down U.S. interest rates. And it's also putting upward pressure on the dollar, which may force the Fed to respond. So I don't see signs that the U.S. is slipping into recession right now, but I do agree that with what the market is saying is that not only is growth prospects here diminishing, but around the world, they're falling probably even faster.
Peter, you go next, and you cite a bond bubble that is very scary to watch. We haven't seen this kind of slide in 10-year yields since really the peak of the debt crisis in the United States. I mean, the idea that we were going to default on our debt back in August, I point out, of 2011.
Well, when we first went to negative interest rates in Europe back in 2014, 2013 with the Swiss and the Danish central bank, you scratch your head and you're like, this is creating a bubble, and it's obviously gone on for much longer and much deeper than anybody imagined. But I think it's clear that, yes, the disappearance of interest rates overseas is certainly led to this inversion here, but there's no question that the U.S. economic trajectory is slowing dramatically. And what's most noteworthy, at least over the past couple of weeks, is that the slowdown in trade and manufacturing is now spilling over into services. And services obviously making up the largest portion of the U.S. economy. That then starts to ask the question of, okay, hiring could get impacted next, consumer spending then can follow and get impacted on the downside, and what this all means. But this is complete la-la land. The world is upside down with negative interest rates. And yeah, it is really scary to see a German 10-year at minus 60 basis points and a German 2-year at minus 80 basis points. It's alarming.
Rick Santelli? Jump in.
You know, obviously I agree with both, especially with Peter. But here's the issue. Do we use traditional monetary policy tools to address this? Do we use negative interest rate tools? We've had some smart guests on today I have great respect for, saying that, get ready, zero rates and negative rates are coming. Listen, I just think it's an intolerable function for the U.S. and its citizens to go there. So what do we need to do? We need to think outside the box. There's definitely a slowdown. Peter described it. A lot of that is feedback loops from trade. But there's more going on. You add in all the negative rates, what the ECB, Bank of Japan, Bank of England have been doing, and their condition worsens so much faster than ours that our multinationals get dragged in. I get it. But the inverted yield curve may be a sign of a recession that starts in Europe and might have an effect on us. But our central bank needs to communicate a whole new message. An inverted curve with a catalyst that is beyond their control should be ignored as a signal. They should fight the fight of trying to hold rates up. Even if market rates are negative, they need to be more of a backstop. We need somebody to shock the system back into normal thinking. And I don't know that our central bank is up for the task, and I don't mean any ill will against any of them, because really J.Powell inherited this mess. And if I had to put a banner as to who caused this, I'm sorry, but Ben Bernanke's name would be first on my list.
Steve?
I'm not sure I agree with that. I think that the proximate cause of all this looks to be tariffs. And if you look at the way the market has reacted, Federal Reserve cut interest rates last week. And things seemed like they were okay for something less than 12 hours. Then a tweet came out, and there's a lot of folks who want to deflect from that proximate cause.
A tweet came out announcing
that there would be new tariffs. And there's a lot of feeling that...
The only thing I'd say about that, and you're absolutely right about the cause and effect over the past week, is when you already have Europe telling us it's going to be the bond buyer of last resort, when you already have Japan playing that role, the backdrop is set. I mean, the yields were negative on German bonds before the Trump tariff tweet.